The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
And welcome back to another episode of The Credit Authority. I am your host, Rhonda Kulch, and I am looking forward to bringing you another amazing show today. So first off, we always want to start by thanking our sponsors. So thank you so much to Equity First. If you are experiencing credit and or financial challenges, feel free to reach out to any one of their trained industry professionals. They could be reached at area code 631-714-4822. They are bilingual and nationwide. So again, waiting for your phone call, credit and or financial challenges, reach out to Equity First. And with that in mind, talk about credit and financial challenges. Our first guest today is Miss Melissa Curtis with Contour Mortgage. How are you?
Hi, doing well. Thank you so much for inviting me on the show today.
You know, we talk about our sponsor, Equity First Credit and Financial Challenges. I know that the mortgage industry is experiencing its own little hiccups right now. How are you handling that?
So that definitely is true. Well, I would say the most important thing that we offer as a company, right, is a diversity of programs. So when one program becomes not so popular, usually what has happened historically is that other programs fall into place, right? So we just saw for the past couple of years, rates were in the 2s, rates were in the 3s, on pretty much every program. So now what's happening is to combat the interest rates that are, some people think, temporary inflated, corrected, however, whatever your opinion is, right? So we have a few programs that allow us to actually combat high interest rates. So one of those programs is Sony May. Those come with very low interest rates, down payment assistance. Another is temporary buy downs. Those are becoming very, very popular. And also sellers' concessions have made a comeback.
So let's break it down a little at a time for those that are listening. So the first program you mentioned is Sony May, which we know State of New York Mortgage Agency. Tell us a little bit about the requirements for eligibility.
Sure. So the eligibility is based upon, number one, income. Okay, so the two most popular programs, one of them has a household income of a little bit under $140,000, and the other one, I believe, is around $176,000. Basically, you have to have a 620 credit score to qualify. The thing with this program is they look for lower debt to income ratios as well. So I had the question asked to me the other day, why go FHA when you can go Sony May, right? So the difference is FHA, which is another government insured loan, they'll allow you to go onto a higher debt to income ratio, whereas Sony May, they want a little bit of a lower debt to income ratio, and the rates are much better, actually.
And part of that makes sense. I think what people fail to recognize when qualifying for a mortgage is that they're qualifying on their gross income, not their net income, which would make sense.
Correct.
FHA allows you to have a larger back-end ratio, like you mentioned, but it doesn't mean that you don't want to say a higher probability of default, but as soon as they have any additional expenses added to the game, they could potentially place themselves in danger.
Absolutely, which is why Sony May, given the great things about the program, right? It has great interest rates. You're able to get down payment assistance, which you don't have to pay back as long as you don't sell or refinance within 10 years. That's, in my opinion, it makes sense, right? Because lending is all about risk. So if they're giving all of this at a 3% down payment requirement, it makes sense for the debt to income ratios to be lower on that program.
I spoke to a client recently that was looking into Sony May, and more importantly, they were able to actually piggyback a grant that they got and utilize that as part of their down payment assistance.
Yes. So grants are great. They are separate from the mortgage company. So you're going to apply for a grant separately and then come back to us and tell us what you're approved for as far as the grant goes.
Now, the second program that you mentioned was, you think I would remember this. We talked Sony May.
Temporary buy downs.
Thank you.
Okay, no problem. I said a lot in that first sentence. So temporary buy downs, they are becoming very, very popular. Basically what it is, to keep it simple, is, say for instance, the rate today is 7%, right? The 2-1 buy down program allows you to get 5%, so 2% less than what the ongoing rate is for the first year. And then in the second year, you're looking at 6%. And then in year 3 to 30, you're looking at that 7%. So it allows you to temporarily have a lower payment. How do you get that? You build it into the price of the house. So the buy down program actually requires a seller's concession. Now, what's pretty cool about this program is, say for instance, just throwing a round number out there, right? Say if the 2-1 buy down cost the client $15,000 in a seller's concession, they can go ahead, if they're doing an FHA loan, 3.5% down, they can get a full 6% seller's concession. So they can apply that to the buy down and then apply the rest of the seller's concession to their closing costs. So essentially, what this program allows someone to do is purchase a house right now with a rate that's 2% less of the ongoing rate, with assistance towards their closing costs.
So they're not really feeling it per se, because that balance has now been re-amortized on 30 years.
Yes, exactly. And there's no prepayment penalty on this program. So we're all estimating rates to drop. Some people say next year, some people say 12 to 18 months. I don't know. I don't have a crystal ball. I wish I did. But what I will say is that there is the ability to refinance once the rates drop. So say, for instance, someone's doing the 2-1 buy down, they're in the year 1 and rates go back down to 4% again. They can actually refinance out of that loan. They don't have to stay in it for a certain amount of time.
When somebody's qualifying for that type of program, are they qualifying on the lower rate or the higher rate?
The higher rate. Great question. So unfortunately, it won't combat the qualifying issues that sometimes we're running into now because of interest rates essentially doubling, right? From the beginning of the year
Absolutely.
till now, they've essentially doubled. So obviously that's cut out a ton of potential buyers. So unfortunately, it's not going to solve that issue. What the issue it's going to solve is it's going to allow somebody that wants to buy a house to get into the house with a lower payment. And the way that we kind of present that to somebody is, because sometimes people will be apprehensive about it, right? So I always ask the question, do you think you're going to be making more money in 2 years from now? What do most people say?
Of course they.
Yes,
yeah,
of course.
Of
course. So, essentially it kind of will sell itself in that way. And it is a beneficial program, hands down.
Which, you know what, I think offers a lot of people a lot of flexibility, as long as that they could become committed to understanding the process so that they don't have the payment shock.
Right. Exactly. So, and that brings me to my third point that I had touched on, which is seller's concession. So a seller's concession, for those of you that don't know, is it's essentially a credit that the seller is giving you towards the closing costs. So if you're doing a conventional loan, if you're putting down less than 10%, you can get a 3% seller's concession. So if you're buying a house for $600,000, you can get a seller's concession for $18,000. Okay. If you're purchasing a house FHA, $600,000, you could actually get up to $36,000 in a seller's concession. So what that is doing is it's allowing buyers to basically have their closing costs paid for and put into the loan or put into the purchase price per se.
So they're almost like self-financing it.
Pretty much. And what I'm noticing as far as trends is a lot of contracts are coming in with seller's concessions, which I did predict a couple of months ago with a bunch of realtors. I said, we're going to start seeing seller's concessions again, because during the height of the market last year, everyone was overpaying. You had lines down the block for open houses, but now seller's concessions, they're back. It's turning into a buyer's market. Buyers have the ability to negotiate. So if you're interested in buying a house right now and you're in the market, see if you can get yourself a seller's concession, because they're becoming a lot more common again.
Are you seeing that buyers are smartening up a little bit?
I am seeing, actually, I haven't seen any shift in that. What I would say is I think that buyers, and just like anything else, I think that a lot of people are playing into the negativity, right? So, like you watch the news, there's a lot of bad news on the news. It's all bad news. So, nowadays, a lot of what the answers that we're getting from people that are on the fence is, well, I want to wait for rates to drop, or I want to wait for prices to drop. And there's a cost in waiting. It really depends. We don't know what's going to happen with interest rates. They may continue to rise. Right now we're hovering in the 7s. They may continue to rise into the 8s, into the 9s. At that point, was it worth to wait?
Shoulda, coulda, woulda.
Exactly. Because think about it this. Right now, if you're a renter,
are not necessarily
sorry, something just came through my so right now, if you're renting, right, you essentially will be faced with after your 12-month lease is up, your landlord can increase your rent.
So it's the same idea.
When you go into a mortgage, it gives you more certainty of what your monthly payments will be.
Which I love. So once again, we are in studio today with Melissa Curtis, Contour Mortgage. How does somebody reach you if they want to ask questions or considering purchasing or refinancing a home?
So you can contact me directly at 516-870-6079. You can reach me at that number anytime, 7 days a week.
You got it. Well, thank you so much for joining us today, and stay tuned for our next guest.
Thank you.